I'm really excited to be here and talk about Chinese investment because, as you all know, this year especially has been a groundbreaking year in terms of the trends and the scale of Chinese investment in America, and especially California. And before we get started, I wanted to give a little bit intro on specifically what we do on Chinese investment. So as Clay said, I am from Rhodium Group. We are a New York-based consultancy. We look at economic trends and policy analysis related to the big disruptive trends that we see globally today. And I'm with the China team. And as we all know, after trade, investment has been the big channel through which China has been impacting the world. So from about 5 years ago, we have been looking in depth at this trend. And specifically, what we have done for the US is that we have taken a ground-up approach, actually tracking every single investment that we can above $500,000 throughout the US. And that serves as the basis for a lot of our analysis. So today, I hope to share with you some of those analysis and the latest reports we have with a quick backstory of Chinese outbound investment and also in the US, specifically diving into Chinese investment in California. Actually, just this year in 2017, we did an in-depth update on this trend, and a lot of the analysis and data that I'll be presenting come from that report. At the same time, however, as we were putting together those reports, 2017 proved to be a very disruptive year for Chinese investment in many ways, especially in terms of policy from both sides. So from there, I will move on to the worries and uncertainties that we saw as we were looking at this data last year, and as well as the outlook, since we're now already 2 months into 2018, and I bring with me some of the latest data that we see just from the last 2 months. So starting with the backstory, I'm sure you are all aware and have been following the Chinese outbound investment story. But one thing that always strikes me about this chart is that, so the orange line is the flow, the annual flow of Chinese global outbound investment, and the blue bar is the stock, it's a total, aggregated. And one thing that always strikes me about this chart is how fast it has taken off, and also how recent of a trend it is. It has really been just in the last less than 10 years that this was a trend. Ever since China joined the WTO in the early 2000s, trade has been the big story, but investment really started to take off in the middle of the 2000s. And right now, China is catching up at an exponential speed, and this is what we're trying to analyze at this moment. At the same time, however, it is still quite small. So the top of the blue bar on the left axis only goes to around 200 billion. So that was China's outbound global investment flow last year. And that, comparing to China's GDP annually at more than 10 trillion, is extremely small and still undercounted in terms of the global average. So we're really expecting this trend to be here and stay. So going from there to the US, we actually see an even more dramatic increase in the US in the past few years. So this is an aggregate chart from our own proprietary data set. We track two kinds of investments. The blue bar is acquisitions, and the green one is greenfield. So for the majority of the past few years, Chinese investment has been coming into the US mostly through acquisitions. Chinese companies are interested in ready assets, strategic assets, and especially companies with a lot of technological branding or supply channel advantages, ready to be able to integrate it into their global business. And that's where we saw the majority of investment. However, at the same time, greenfield is also taking off. And a lot of the projects that Clay mentioned just now, just within a few miles of USC, are all greenfield investment, where Chinese companies are building from the ground up, buildings, projects, factories. And that part we foresee also taking off, especially in the last few years. We're seeing this trend of made in America or coming back to America, even by Chinese companies. And I look forward to discussing in more detail with you today on those trends. And lastly, before we leave this slide, I wanted to highlight the huge jump last year in 2016. So as we were putting together this report in 2017, we had one of the biggest jumps in Chinese investment in the US, more than tripling from about 15 billion to 46 billion. And 2016, it turned out, was a little bit of an anomaly last year. And in 2017, we were back to, and this is the latest data since we just wrapped up the end of the year a few months ago. In 2017, we're back down to about 30 billion, down from 46 for sure, but no less still the second highest on record that we have. So we're seeing a continuation of a growth trend. But at the same time, something definitely happened between 2016 and 2017. And in the policy sections, I hope to present to you some of our research on this. A little bit more detail looking at the trends. So instead of just going up in an exponential way, actually the composition of Chinese investment, especially in the US, has been changing a lot, actually. So at the beginning, I hope it's visible, but the dark blue before about 2012, a lot of that is consisted of energy, metals and minerals, extractive sectors where we see Chinese investments taking advantage of natural resources in the US, the shale gas boom, and a lot of, say, consumer products and services. Because there was a lot of trade offices and representative offices in the US. Like Clay mentioned, Air China, Bank of China, services providers with customers in the US were the majority of investors, and a lot of state-owned companies during that time. But in the last few years, as you can see, a couple of sectors really stood out and started to grow. The biggest one is real estate and hospitality, the green bar. And electronics, ICT, and high-tech investments as well, and entertainment, which is also very relevant to the LA area. In general, in 2016, we saw that investment into advanced services made up more than 2/3 of total investment, versus in the earlier years, it was almost entirely manufacturing and primary sector investment. So breaking that down into geographically the US and trying to come to California, this is a stock photo that we have on our website. This is our interactive investment tracker where every single state, the number of projects and the total value of projects by industry, by year is available. This I took in 2017, so that's as of 2016. But as we saw, if you drag the little time bar on our website, it became almost like a little animation from entirely blank in the US, and now more than 48 states that we have by operations, and more than 46 states by headquarters locations. And this is what this map shows of Chinese investment in the US. So it's really not a West Coast or East Coast trend, or even Texas trend, the third coast of the US. It's really across America that we're seeing Chinese investment. In addition, this perspective is the one I will be presenting on going forward on Chinese investment in California. So it is by headquarters location, which means, for example, if we have a huge investment in a company that is spread across the US, we log all of that at the headquarters location. With that, tallying up by state, California is by far the biggest state in the US for Chinese investment. Last year, before 2017, it was almost twice as big as the second place in New York. And in 2017, if I remember correctly, New York did caught up with another huge $10 billion deal, but still California remains the top recipient state of Chinese investment. So going into more detail in California investment, this is the trend that we see. The same chart that we have for the national perspective, but for California. And as we can see, the increase is even more dramatic. In 2016 especially, a lot of the mega deals that we saw that year that pushed up 2016 to be such an anomaly was right here in California, especially in sectors like real estate and entertainment. And looking back in the past 5 years especially, growth has not only been increasing, it has been broadening in California. So this is the total stock picture that we see in California by industry. And the top 4 for California we have is ICT, transport and infrastructure, real estate and hospitality, and entertainment. So the vast majority of it, actually more than 2/3 of Chinese investment up until 2016 have been concentrated in these 4 areas. And actually this was a little bit of a surprise to me because, for example, real estate and entertainment catches a lot of media attention and we see the big deals coming out. But actually, traditionally, California has been quite competitive in transport and logistics and ICT, especially high tech. That actually was the top 2 investment sectors if we tally it up from 2000 to 2016. And this is a lot of the new trends we're seeing actually also in high tech and in a little bit of security sensitive sectors. And that actually would have a lot of impact on Chinese investment, the trend of Chinese investment going forward because of what we're seeing in 2017, which we'll get to in a little bit in the policy section. So we also did a analysis comparing California to the US as a whole. So if we look at the breakdown of Chinese investment in California by industry versus the rest of US, it's very clear that investment in California is a little bit more concentrated, but at the same time is also targeting different sectors than the US as a whole. There's a lot more services and high tech, and is also in completely different sectors that's more corresponding to California's competitive advantage. And taking a geographic perspective within California. So here we have the actual geographic location of every single operation, and it's very clear that Chinese investment is concentrated in the Bay Area and LA. And since we're here today, I zoomed it on even more to look at investment in Southern California especially. And to give a little background on this, so beyond the real estate investments that we see a lot of times dominating headlines, actually in the beginning, back 10 years, around 2008, Chinese investment in the Southern California area really started out with transportation and logistics. A lot of shipping companies like Costco or China Shipping and private shipping companies were based here because of the big Chinese population. And even today, in Long Beach, in Los Angeles, there's still quite a big presence of these companies. And they were the concern, actually, of several politically sensitive deals. And it continues to be a big driver in Chinese investment in California, as well as a point of potential tension going forward. Around 2011, 2014 is when we started to have a diversification of investments. That's when we started to see the first hotel investments. The downtown Marriott was around that time. We also had some gaming investments, like the Riot Gaming acquisition was around 2011, 2014. And most recently, around 2014 to 2016, is when we started to see a lot of the big entertainment investments we had. AMC was during that time, and there's, of course, a lot of theaters around this area. But because of Hollywood, there's a lot more follow-up investments after that by Wanda and other actors such as State Channel, like Hunan Movies, Hunan Channel. At this time, we also saw a lot of consumer products, consumer services-oriented investments, such as banking and business services. The Bank of East Asia, USA, was acquired around this time as well. And a lot of the operations based around Southern California is geared towards serving the Chinese community that was already here, as well as the new travel boom from China. So in 2016, we had one big deal that really pushed up investment in Southern California, which is also in a logistics distributor called Ingram Micro. They're based in Irvine, and actually the deal was almost $6 billion. So a lot of that huge jump in 2016 was due to this one deal. The company distributes electronics all throughout the US with a huge logistics network. So I decided to go in a little bit detailed just to highlight the ones that might be of interest for California, but especially Southern California. So for information communications technology, a lot of it, of course, is based in San Francisco with the startups investment and private equity venture capital seen from China. But actually, we have a lot of them in Southern California as well. For example, some of the earlier players have been Huawei or ZTE. Even though they're not officially selling here in the US, there have been a lot of R&D investments and sales network here in California because we're such a big state for technology talent. More recently, we have Tencent being here for gaming investments, but also actually a lot of semiconductor acquisitions happening in the last few years. One of the things that Chinese government is very actively involved in here is guiding the national policy for outbound investment in sensitive strategic sectors. And semiconductor is one area where we clearly see that happening. In around 2015 to 16, we just had a tremendous jump in the attempt to acquire US semiconductor companies, and a lot of that was based in California. So in total, I think we saw more than 30 billion of announced deals, but the majority that went through, which was around 3 billion, was all based in California. One is called OmniVision Technology, and the other one is called Integrated Silicon Solutions Company. So both are in California because we have such a strong tradition in the Silicon Valley for these types of old semiconductor companies, and it's also the I would say #1 sensitive area going forward to be aware for Chinese investment in California. The impact of these government or more policy-related investments. The second one, of course, is real estate and hospitality. This one we saw a huge boom of, and that's probably the one that everybody sees in the media or even walks by. I live by a Wanda development right now too. And that's something that in the middle of the 2000s we started to see, but really in the last 2 years, in 2017, as we saw before, real estate was a big sector pushing up Chinese investment in the US. And the reason for that is really a diversification and a chase for returns because of a lot of these real estate and hospitality projects are so stable as well as profitable. A lot of Chinese companies, even though they're not in this sector specifically, they would like to hold real estate and hospitality assets. So we see ones like Oceanwide or Wanda or Vanke doing a lot of investments in Southern California and the Bay Area sector. But we also at the same time see, for example, technology companies or construction companies, or even just a diversified holding group like, for example, Outbound Insurance buying a huge hotel in New York, or Fosun holding a lot of real estate around California. And that trend really reached a peak in around 2016. In last year, to give a quick update of what happened, besides what you can see, the visible stalling of the big construction projects, we also see a huge drop-off in the announced interest in both acquisitions as well as new investments for Chinese real estate and hospitality investment in California. And to top it off, there's even some selling off of assets that were already bought. For example, Wanda is actually thinking about selling off the Beverly Hills project that they worked so hard to get. And even in California, in the Bay Area, we also see a similar trend. And that's because on large parts, Chinese policy change during this time, but also at the same time, we see a lot of these companies, because they were expanding very fast in the 2016-15 time, they ran into a lot of financial troubles, and a lot of that sort of impacted the ongoing construction and cash flow last year in 2018. So for California, for Los Angeles, of course, entertainment is the big one. And we saw this shooting up in the last year in 2016 because of one huge deal, also by Wanda in Legendary Entertainment. This one is quite similar to the real estate story, where in 2016, because this was such an attractive asset, just to give an example, when Wanda bought Legendary, they in turn took that public in China and basically doubling the value within a couple of months. And before getting the deal, they even entered some domestic financing deals, promising more than 10% return for this deal within a short period of time. So that was the environment during which we had a lot of 2016 entertainment deals. And not just in California, for example, in Europe, we had a lot of football clubs and sports deals. And in California, we had a range of failed acquisitions that were during this time. For example, Wanda tried to acquire a studio called Dick Cook, Millie Pictures, China Recon Group, basically entertainment as well as real estate, real economy companies trying to take advantage of this trend. And in 2017 and 18, to give an update, this part basically went down and crashed back to lower than 2015 level now. Financial business services is also one of the sectors I briefly touched on. And this one sort of goes into the area where I feel is important to bring up, because it's not as visible as some of the top sectors, but it's really a point for further growth. Because we are seeing a lot more new activities in the sector beyond, for example, Bank of East Asia USA and the traditional business services like transportation that we see in the early 2000s. Right now, what we're really more seeing are internet financing companies, private equity or venture capital into this field. For example, a couple of a couple of U.S. companies based here in California that are partially owned by Chinese companies might be Lending Club, Social Finance, Zest Finance, Asset Mark. A lot of the new up-and-coming trending tech investment companies that we hear about actually has substantial Chinese investment. And a lot of this was based in San Francisco at the moment, but we do see it as a big point for growth and for business services, especially as the Chinese community and Chinese travel boom really comes to California, the service that accompany them will likely come as well. And the last sector I wanted to also mention in this capacity is health and biotech. This is a big sector we see for a lot of the other U.S. Areas like Boston or Philadelphia, but also for San Diego, really. So for Southern California, health and biotech has been a huge sector for us in terms of Chinese investment. And in the last 2 years or so, we're also seeing the same type of boom that we see for financial and business services, health startup, medical technology, as well as traditional pharmaceutical assets are becoming extremely attractive. And as we go forward and think about the outlook in 2017 and 2018, this is also an important sector in that is one that has been curiously caught between the sectors that are quote-unquote restricted from the Chinese side, but also not on the list of sectors that's considered security sensitive from the U.S. side. So actually in 2018, in the last 2 months or so, this is one sector where we saw tremendous growth, more than doubling in 2018 from what we see here up to 2016. And for health and biotech, even though it's starting slow at the moment, we see a lot more participation from both Chinese pharmaceutical companies, but also financial groups who also are coming into this because of the big promise of return. So for California, I do believe that these two sectors are the ones to watch out for next. So moving forward a little bit into the impact and the outlook for Chinese investment in California now that we saw the history of it. So California has benefited from Chinese investment in many ways, but the most obvious way is probably employment. So the number of California households that are on Chinese payrolls at the moment, and this is one thing that we also started tracking in recent years. And as you can see, employment has taken off with investment to more than 20,000 in 2016. And this is important because we wanted to look at if a lot of the investments were going into sectors such as, for example, real estate, that was basically all returns and asset holding rather than employing actual people on the ground. And it turns out that for California, even though those are what we see in headlines, the mega acquisitions, actually the employment impact has kept up with Chinese investment. And there's a range of diverse sectors that Chinese investment is making an impact on the ground. On the chart is a list of the top investors in California, top Chinese investors by investment. And we looked into more specifically who exactly is investing in California. So besides those few that I listed just now on the slide, we took a holistic view of all the investments we have. And for the investor, we put them on 2 scales and 4 quadrants. So on the vertical one, we have state-owned and private firms. This is the straightforward way to describe the investor when we come to Chinese companies. But at the same time, we also divided them into financial and strategic investment, which just means if the company is investing in this company purely to hold it for financial returns, or do they want to have strategic integration or long-term business planning with the business. And we put every single investment that we track on this field in each of the 4 quadrants. And as we can see, the vast majority of Chinese investments in California tend to be strategic investments by private firms. And that's actually not exactly the norm here in the US. So California investments tend to be a lot more driven by private firms than state-owned compared to all of US, certainly compared to, say, in Europe or the Belt and Road countries these days. And they also tend to be overwhelmingly strategic compared to, for example, in New York, even though it was a second-ranking state, there was a lot of financial investment there, big hotels and real estate investments that aren't making too much impact in terms of employment and other local benefits. And this is a profile by province, the source province for those Chinese investments. Is actually quite similar to the US as a whole. We have Beijing and Guangdong as some of the top investors, and Beijing especially because it's headquartered for a lot of the state-owned companies. But a few stood out. For example, Hainan is extremely high up because of HNA, which is headquartered there. Lastly, going forward, now that we've covered the landscape, the current landscape for Chinese investment, when we look at Chinese investment in California in the past few years, we see some sectors really coming up quick, even though the total investment right now might not put it in the top 4. So this is our analysis, the result of our analysis looking at that. The annual average growth rate from 2014 to 16 versus the 3 years before. So this really puts things into perspective for the sectors to watch out for. We have cumulative investment from under 100 million to 102 billion and over 1 billion. And growth momentum for under 0% to 0%. And high growth is 0 to 100%, and actually hyper growth is 100 to 1,000% growth for the past few years that we see. And besides entertainment, transport, and financial services that we see are both growing very fast and very big at the moment. We also see things like electronics, automotive, even ag and food that is in the mid-range, but is growing decently in California. And for our analysis of California's competitive sectors, that also makes a lot of sense. For example, automotive manufacturing, even though it hasn't been a traditional sector for California, it is very big for things like electric vehicles or autonomous driving. A lot of Chinese companies are making inroads here. For example, Fisker Automotive, that's based actually just right around here, is acquired by a Chinese company called Wanxiang, and they're making models of their old car in a new factory here. And BYD has been here a couple of years making electric buses, and even unfortunately had some trouble. Faraday Future is headquartered around here. So we do see a lot of potential for automotive in California. And same thing with ag and food. We are one of the biggest states for agriculture, and China is definitely having a lot of demand in that area, and there's we do foresee potential synergy in these areas. And lastly, one area that we are starting to look at and is very, very new, a 2018 database that we put together, is China-based venture participation and venture capital funding in California. So traditionally, we've looked at foreign direct investment, meaning at least 10% ownership in a foreign company, because traditionally that's what denotes actual control. But it's quickly changing, especially for California, for a lot of tech startups in the Bay Area and for all kinds of startups around the Southern California area, for example, healthcare and biotech. We're seeing a lot of Chinese participation in these companies, and because they're not as transparent and they're very early on, the amount of control and the amount of investment is unclear at the moment. But what we've tallied together is the number of funding rounds. And as we can see, since 2014, this has taken off dramatically, and it is also a key area for going forward, the outlook for Chinese investment in California. Related to that is high-tech investments in general. Even though in terms of dollar values, this hasn't been a big trend so far, but around the Bay Area especially, Chinese companies are coming in to really take advantage of the research environment. A lot of the companies we see might not have operations in the US yet, but their entire R&D office is actually based in California. And these are just some of the examples that we see. So for all those areas, we do see a huge competitive advantage for California. And moving forward from real estate, from entertainment, these will be the new sectors, we believe. And from there, we sort of go into 2017, what we see now. A lot of the story that we present has been super smooth and just a beautiful curve going up for Chinese investment in California and in the US overall. But actually 2017 turned out to be the very first year that Chinese outbound investment globally has declined. So from around 200 billion that we saw at the very beginning in the first slide, it actually declined to around 120 last year, which is quite unprecedented for China, the first decline in about 30 years. So this was the result of a mixture of political and commercial situations. And some of these worries and uncertainties that we see include capital controls from the China side on outbound investment, from coming the US, more attention on reviewing inbound foreign investment, and just a broader backlash against Chinese investment now that investment flows have been much more open and high profile. And overall geopolitical risks from the US-China relationship. And lastly, at the same time, clashing with all of that is that the commercial and economic incentive and interest for outbound investment from both sides is higher than ever. So we're really looking at a complicated situation at the moment, and it is quite evolving fastly and as we speak. So a little bit more detail on that is, so this is what we see in terms of China's balance of payments, the going in and going out of financial flows, both sides. We have the general financial account, which includes the majority of it is actually direct investment, along with some other portfolio and other investments. And then we see the current account denoting the traditional trade flows. And then lastly, the unexplained errors and omissions, basically the quote-unquote gray flows out of China. And as we saw for the last 2 years, it has been really coming down. While China maintained a quote-unquote double surplus in both the trade and financial account before, in the past 2 years, it has really run into a deep deficit with the unexplained errors and omissions, especially aggravating towards the end of 2016. So this was really the trigger for Chinese government adding restrictions on outbound investment at the end of the period that we were looking at just now, around the end of 2016 and the beginning of 2017. And in August 2017, all of these informal rules that we saw were happening became a formalized new regulation where Chinese government, instead of maintaining an open stance towards outbound investment, actually came out with a list of encouraged, restricted, and prohibited sectors for outbound investment. Encouraged being infrastructure, Belt and Road investments, anything that will perpetuate Chinese export of technology and other standards, etc. And restricted, we see a lot of the things that we actually saw before driving Chinese investment, including real estate, hospitality, theaters, entertainment, and sports clubs. Exactly the investments that we see driving more than half of Chinese investment in 2016. As well as anything with a financial nature. So no physical operation abroad, any funding platforms. So this was directly one of the biggest reasons why we saw a huge decline in the beginning of 2017, lasting until now. At the same time, from the US side, we also have a pushback during this time. The high level of Chinese investment that we saw in 2016 really triggered a lot more attention from Washington on the sort of investment that's coming in and whether the US is managing it correctly. So the foremost entity for reviewing this and managing this is the Panel on Foreign Investment in the US, short is CFIUS. So CFIUS reviews Chinese investment only for national security reasons, and they have the authority to block or ask them to revise the investment. So this is only our estimation because CFIUS record is not transparent, but based on our count, at the very least for Chinese investment in California, there has been a huge jump in the amount that is held up by CFIUS, by U.S. regulatory review, actually. Partially, this is definitely warranted because of the kind of investment that I mentioned in, for example, semiconductor that is directed by the government. But on the other hand, there is also a lot of concerns just driven by the pure amount of investments coming up. Because if we look at this chart, it's actually quite similar to the investment flows chart that we see. So a lot of this uptake perhaps is not CFIUS becoming more restrictive on Chinese investment, but just the pure number of investment going up. Lastly, there's a general uneasiness about Chinese investment and especially bilateral investment at the moment, not just in the US but globally, because of the asymmetry in policy opening up to foreign investment. So even though Chinese investment has been largely able to invest abroad without restriction, actually investment in China has had to abide by a range of Chinese rules. Every single investment actually needs to go through approval, and there's a list, again, of encouraged, restricted, and prohibited sectors. And because of that, there's a lot of concerns about reciprocity and overall fairness of the system. So fielding backlash from both the US and EU at the moment. And this is the best representation that we can find for that is a FDI openness index put together by the OECD. And we pulled out the numbers for US and China by sector. So higher means that it's more closed, and 0 means that there is no restriction at all. And as we can see, China generally has higher restrictions by sector, and especially highest in a lot of the sectors that is most important to California, or will become very important for California. So with all of that, a quick update on the impact on investment flows is that actually in 2017, for announced transactions, this is not yet the completed view that we have been looking at, but just the announced incentive for investment has dropped down a lot since 2016 and reached the lowest point by the end of last year. At the beginning of 2018, we are beginning to see a little bit of recovery after the formal regulation is out, and there's been a little bit of clarification. But at the same time, the drop actually here, if we were to do the same chart for California, is even sharper because of those sectors that have been driving investment into California being restricted now. So if we take a long-term view, however, wrapping all of this up, hopefully on a positive note, is that on a theoretical economic sense, we do see that Chinese investment should be a very long-term trend. As I mentioned at the beginning, 200 billion a year is extremely low for an economy that is 10 trillion a year in GDP. And because of that, we did just a very quick calculation of FDI stock to GDP for the world. And for China, going forward, even if we were looking at the world average for this, still that will put us around 2 to 3 trillion of investment, outbound investment stock. And the optimistic scenario is even higher than that. So the story of Chinese outbound investment in the US, in California, really wouldn't be dropping for the long run, but we do see a lot of political and commercial uncertainties that is impacting it at the moment. Lastly, I wanted to show this chart, which puts all of the foreign investors in the US in perspective with China. So even with all the investments we have seen in the past several years, China still makes up less than 1% of total foreign investment in China, in the US. So again, a lot of potential and huge interest, but at the same time, there is from both sides a lot of headwind against that. And at the top of it actually is California because of the specific sectors that we are in and the competitive strengths that we are heading to. So being the state with the #1 Chinese investment at the moment, I do foresee that a lot of this development will actually play out in California this year. And our overall outlook is a little bit mixed, as you can see, but we also remain quite optimistic.